Well, tech spending is one of the big reasons why our guest trader, Savita Subramanian, is bullish on stocks. She's got a 66 price target on the S&P 500 for next year, which implies a 10% gain from today's close. So what should we know about you? Like stock picking here. That's how we'll get there.
I like stock picking, but I think even the index, it's hard to say there's more downside risk than upside risk. And here's my call. I know that everybody is bullish and it feels like sentiment has hit these really high levels where you want to sell. But the truth is there is euphoria in one specific pocket of the market, and that is mega cap tech. Outside of that, there's not a lot of bulls on your average company. The other factor that I think is so interesting is if you look at the spread between the average S&P company and the index itself, massive difference. So, you know, again, I'll say it again, and we all know this, but the index is very top heavy, but the average company in the index is actually trading at relatively healthy multiples. I think, you know, going back to this manufacturing theme, I think this could be the beginnings of a stronger environment for manufacturing. Because when you look at, you know, ground that's been broken around reshoring or building out grid and infrastructure, we're in an environment where this is a long-tailed theme. Most tech companies have told us that the key risk around AI is underinvesting. So they've basically told us they're going to spend a lot of money over the next several years on not just tech, but, you know, power, infrastructure, metals, machinery. A huge pickup, I think, in terms of manufacturing dollars spend. Yeah.
As a strategist, do you always believe what companies are going to tell you about what they need to do going forward? And I mean that sincerely, because again,
no, you have to chronically disbelieve what they're saying.
Because the upside to CapEx spends, as a percentage basis, keeps going lower. I know the numbers, the absolute numbers, are going higher. That's the one thing I would kind of worry about, because if the rest of the sectors that have not been infected or not euphoric, as you just mentioned, don't spend, if they don't see the return on investment, then the CapEx is going to come down pretty quickly.
Well, I don't necessarily think so. In fact, I think what we're seeing now is just the beginnings of an acceleration in CapEx. And here's why. The U.S. has underinvested in its own infrastructure for more than 10 years, right? Stuff is old in the U.S. and it's starting to break. Meanwhile, since 2015, we've moved all this manufacturing capability from other parts of the world to the U.S. And we're starting to see municipalities fray, right? I mean, if you look at the accident rate in certain municipalities, it's really jumped up just over the last couple of years because of all this extra activity. So I think that there's an almost mandatory infrastructure rebuild, get efficient. I mean, look at all the equipment that companies are using. It's not efficient. If they replace it, they'll become that much more efficient. And that involves spending money on old economy, you know, machinery and construction and commodities. And, you know, so I think that this is really an environment where we all poo-poo the idea that the U.S. could ever see a real spending cycle. But we're there. All the ducks are in a row. We're not able to move to other parts of the globe anymore. In fact, we're moving back to the U.S. More activity here, more activity up and down the North America corridor from Canada to Mexico. So I think that all of this is creating this perfect storm for cyclicals to outperform in a really material way over the next several years. Meanwhile, conversations with clients are all about tariffs, throwing the world into a global recession. We're still in this environment where folks are looking at the glass as almost empty. Meanwhile, I feel like it could runneth over. I'm going to use some fancified terms here, too. But I think that we're at a point where the U.S. economy could be really surprisingly strong, which means inflation, which means less Fed cuts, but it's also positive.